Chapter 1 of The Psychology of Money by Morgan Housel is titled No One's Crazy, and it explores the ways in which our individual perspectives and beliefs shape our financial decisions and behaviors. The chapter begins with a story about two investors, Richard and James, who have vastly different approaches to investing. Richard is risk-averse and prefers to invest his money in low-risk, low-return options like bonds, while James is more adventurous and invests in high-risk, high-reward options like stocks. Housel notes that both of these investors are making rational decisions based on their own beliefs and experiences, even though their strategies are completely different. Housel then goes on to explain that we all have different beliefs about money and investing, and these beliefs are shaped by a variety of factors, such as our upbringing, education, and personal experiences. He argues that understanding these beliefs and how they influence our financial decisions is key to becoming a successful investor. Housel points out that our beliefs about money and investing are often shaped by our emotions and biases, which can lead us to make irrational decisions. He cites a study that found that people are more likely to buy a stock if it has a sexy ticker symbol, even if there is no rational reason to believe that the stock will perform well. Housel also notes that we tend to focus too much on short-term gains and losses, and not enough on the long-term consequences of our financial decisions. He uses the example of a couple who buys a house they can't really afford, but justify the decision by saying that they can always sell it for a profit in a few years. This short-term thinking can lead to financial disaster in the long run. The chapter concludes with a reminder that no one has all the answers when it comes to investing, and that we should be open to learning from others and admitting when we are wrong. Housel encourages readers to embrace their own individual beliefs and perspectives, but also to be willing to challenge them and learn from others. Overall, Chapter 1 of The Psychology of Money highlights the importance of understanding our own beliefs and biases when it comes to money and investing. By recognizing the ways in which our emotions and biases influence our decisions, we can make more rational and informed choices, and ultimately achieve greater financial success. Chapter 2 of The Psychology of Money by Morgan Housel is titled Luck Risk, and it explores the role of luck in our financial success or failure. The chapter begins by explaining that luck plays a significant role in all areas of life, including finance. Housel argues that while we like to think that our financial success or failure is solely a result of our own hard work and skill, luck often plays a much larger role than we realize. Housel then goes on to explain the difference between luck and risk. He defines luck as an event or situation that is largely outside of our control, such as being born into a wealthy family or winning the lottery. On the other hand, risk is a situation where the outcome is uncertain but can be influenced by our own decisions and actions, such as investing in the stock market. Housel notes that it is important to distinguish between luck and risk because our responses to them should be very different. For example, if we experience a stroke of luck, we should be grateful but not assume that it will continue forever. Similarly, if we take on too much risk, we may end up with negative consequences that we did not anticipate. The chapter then explores the concept of survivorship bias, which is the tendency to focus on the success stories and overlook the failures. Housel notes that survivorship bias can be particularly dangerous in the world of finance, as it can lead us to believe that financial success is solely a result of skill and hard work, rather than luck. Housel also discusses the idea of the circle of competence, which is the idea that we should only invest in areas where we have a deep understanding and knowledge. He argues that by staying within our circle of competence, we can better assess the risks and avoid making foolish decisions based on luck or outside factors. The chapter concludes with the reminder that luck and risk are intertwined, and that our financial success or failure is often the result of a combination of the two. By acknowledging the role of luck in our lives and taking calculated risks within our circle of competence, we can set ourselves up for greater financial success over the long term. Overall, Chapter 2 of The Psychology of Money emphasizes the importance of understanding the role of luck and risk in our financial lives. By recognizing the factors that are outside of our control and staying within our circle of competence, we can make more informed decisions and increase our chances of achieving financial success over the long term. Chapter 3 of The Psychology of Money by Morgan Housel is titled Never Enough, and it explores the concept of human nature's insatiable desire for more money and material possessions. The chapter begins with a story about a man named John D. Rockefeller, who was once the richest man in the world. Despite his immense wealth, Rockefeller was known for his frugal lifestyle and his unwillingness to spend money on frivolous things. Housel argues that Rockefeller's approach to money was based on the realization that no matter how much money he had, he would never truly feel like he had enough. Housel then goes on to explain that our desire for more money and material possessions is deeply ingrained in human nature, and that it is often the result of social comparison. He cites a study that found that people are more likely to be satisfied with their income if it is higher than their peers, even if it is not enough to meet their basic needs. The chapter also explores the concept of hedonic adaptation, which is the tendency for humans to quickly adapt to new levels of wealth and happiness, and then start desiring even more. Housel notes that this tendency can lead us to a never-ending cycle of chasing after more money and material possessions, without ever feeling truly satisfied. Housel also notes that our desire for more money and material possessions can have negative consequences on our overall well-being. For example, it can lead to a constant sense of anxiety and stress, as we worry about losing what we have or not having enough. It can also lead us to neglect other areas of our lives, such as our relationships or personal growth. The chapter concludes with a reminder that while money can certainly bring happiness and security, it is not the only factor that contributes to a fulfilling life. By focusing on what truly matters to us and avoiding the trap of constantly chasing after more, we can achieve greater satisfaction and fulfillment in our lives. Overall, Chapter 3 of The Psychology of Money highlights the insatiable nature of human desire for more money and material possessions, and the negative consequences that can result from this constant desire. By recognizing the limitations of money and focusing on what truly matters to us, we can achieve a greater sense of fulfillment and well-being in our lives. Chapter 4 of The Psychology of Money by Morgan Housel is titled Confounding Compounding, and it explores the power of compounding in investing. The chapter begins by defining compounding as the process of earning interest on interest, or returns on previous investment gains. Housel notes that while compounding may seem like a simple concept, its effects can be truly staggering over the long term. Housel then goes on to provide several examples of how compounding can work in practice. For example, he notes that an investment that grows at an annual rate of 7% will double in value roughly every 10 years. He also notes that the difference between investing $10,000 at age 25 versus age 35 can be hundreds of thousands of dollars over the long term, due to the power of compounding. The chapter also explores the importance of time in the compounding process. Housel notes that the longer we can let our investments compound, the more powerful their effects will be. He cites Warren Buffett as an example of someone who has benefited greatly from the power of compounding over the course of his long investment career. However, Housel also notes that while compounding can be a powerful force for good, it can also work against us if we take on too much debt or make poor investment decisions. He cites the example of credit card debt, which can quickly compound over time and lead to financial ruin if not managed carefully. The chapter concludes with a reminder that while compounding can be a powerful tool for building wealth over the long term, it is not a magic solution that can solve all financial problems. It is important to make smart investment decisions, avoid excessive debt, and give our investments enough time to compound in order to truly benefit from its effects. Overall, Chapter 4 of The Psychology of Money emphasizes the importance of understanding the power of compounding in investing, and the role that time and smart decision-making play in maximizing its effects. By recognizing the potential benefits and pitfalls of compounding, we can make better informed investment decisions and set ourselves up for greater financial success over the long term. Chapter 5 of The Psychology of Money by Morgan Housel is titled Getting Wealthy versus Staying Wealthy, and it explores the differences between building wealth and maintaining wealth over the long term. The chapter begins by noting that building wealth is often viewed as the ultimate goal of personal finance. However, Housel argues that while building wealth is certainly important, it is not enough on its own to ensure long-term financial success. Staying wealthy, he notes, is just as important, if not more so. Housel then goes on to provide several examples of individuals who have built immense wealth, only to lose it all later on. He cites examples such as Mike Tyson, who earned over $400 million during his boxing career, but ended up declaring bankruptcy due to poor financial management. He also notes that many lottery winners end up bankrupt within a few years of their big win, due to a lack of financial knowledge and discipline. The chapter also explores the importance of risk management and maintaining wealth over the long term. Housel notes that while taking risks can be an important part of building wealth, it can also lead to catastrophic losses if not managed carefully. He cites the example of the dot-com bubble in the early 2000s, which led to many investors losing significant amounts of money due to overinvesting in risky technology stocks. Housel also notes that staying wealthy requires a different mindset than building wealth. He argues that those who are successful in maintaining their wealth over the long term tend to be more conservative and risk-averse, and are willing to prioritize long-term stability over short-term gains. The chapter concludes with a reminder that while building wealth is certainly important, it is not enough on its own to ensure long-term financial success. By focusing on risk management, adopting a conservative mindset, and prioritizing long-term stability over short-term gains, we can increase our chances of staying wealthy over the long term. Overall, Chapter 5 of The Psychology of Money highlights the importance of staying wealthy, as opposed to just building wealth, in achieving long-term financial success. By adopting a conservative mindset and prioritizing risk management, we can increase our chances of maintaining our wealth over the long term and achieving greater financial stability and security. Chapter 6 of The Psychology of Money by Morgan Housel is titled Tails, You Win, and it explores the concept of risk and how it affects our financial decisions. The chapter begins by noting that risk is an inherent part of investing and finance, and that it is impossible to completely eliminate it. However, Housel argues that while risk cannot be eliminated, it can be managed and mitigated through smart decision-making. Housel then goes on to provide several examples of how risk can play out in the world of finance. For example, he notes that the stock market is inherently risky, but over the long term, it tends to produce higher returns than less risky investments such as bonds. He also notes that taking on too much debt can be risky, as it can lead to financial instability and bankruptcy if not managed carefully. The chapter also explores the concept of asymmetric risk, which refers to situations where the potential downside risk is much greater than the potential upside gain. Housel notes that while asymmetric risk can be dangerous, it can also present unique opportunities for those willing to take on risk in search of high potential rewards. Housel also notes that risk is often relative, and that what may be considered risky for one person may not be for another. He cites the example of a billionaire investing a small percentage of their net worth in a high-risk investment, which may be considered a small risk for them but a huge risk for an average investor. The chapter concludes with a reminder that risk is an inherent part of finance, and that it cannot be completely eliminated. However, by adopting a conservative mindset, avoiding asymmetric risk, and managing debt carefully, we can reduce our exposure to risk and increase our chances of achieving long-term financial success. Overall, Chapter 6 of The Psychology of Money emphasizes the importance of understanding risk and how it affects our financial decisions. By recognizing the potential risks and rewards of different financial strategies, and taking a measured approach to managing risk, we can increase our chances of achieving our financial goals over the long term. Chapter 7 of The Psychology of Money by Morgan Housel is titled Freedom, and it explores the idea that money can provide us with freedom and autonomy in our lives. The chapter begins by noting that while money is not the only factor that determines our happiness and well-being, it can certainly play a role in providing us with the freedom to pursue our passions and live life on our own terms. Housel notes that financial independence, or the ability to support ourselves without relying on a traditional job or income source, can be a powerful tool for achieving this kind of freedom. Housel then goes on to provide several examples of how financial independence can lead to greater freedom in our lives. He notes that having a strong financial cushion can provide us with the flexibility to take risks and pursue our passions, whether that means starting our own business, traveling the world, or simply spending more time with our families. The chapter also explores the concept of enough, which refers to the idea that there is a point at which we have enough money to be comfortable and happy, beyond which additional money may not bring us much additional happiness. Housel notes that understanding what enough means for us personally can be a powerful tool for achieving greater financial freedom and autonomy in our lives. Housel also notes that achieving financial freedom requires discipline and planning. He suggests that individuals who are interested in pursuing financial independence should focus on reducing their expenses, increasing their savings rate, and investing in a diversified portfolio of assets. The chapter concludes with a reminder that while money is not the only factor that determines our happiness and well-being, it can certainly play an important role in providing us with the freedom and autonomy to live life on our own terms. By pursuing financial independence, focusing on enough, and making smart financial decisions, we can increase our chances of achieving greater freedom and autonomy in our lives. Overall, Chapter 7 of The Psychology of Money highlights the importance of understanding the role that money can play in providing us with freedom and autonomy in our lives. By pursuing financial independence, focusing on what enough means for us personally, and making smart financial decisions, we can increase our chances of achieving greater freedom and autonomy in our lives and living a more fulfilling and satisfying